When you look at Fed possibilities, I guess you have to put yourself in the mind of Donald Trump and try and figure out whether he wants someone who's loyal to him. And that would most likely be Kevin Warsh because of the links of his father-in-law has with also donations to the Trump campaign, or whether he actually wants a dove. What can we figure out in all of this?
I think probably both. And I'm not sure Kevin Warsh would be as hawkish as the market is perceiving him. I do think that the candidates who have been critical of the Trump administration, like Janet Yellen on regulation or Cohen, are probably
Are they discarded,
second choices at the moment. So it comes down, in our view, to Warsh or Powell. The first one is a bit more hawkish, but I think both could be candidates that would work in tandem with the administration. So we're probably not going to have a Federal Reserve that acts against what the administration is doing, right, which means a very low terminal rate. Already the Fed has put it at 2.75%, which is the lowest ever.
All right, Alberto, let me bring you over to my WIRP function. Now, we're looking at treasuries. We'll have a little bit of calls, of course, on what we see and what we can do. What I'm concerned about, I guess, is that if you look at the probability of a hike, so this has significantly been repriced in the last couple of weeks, if not months, and yet you look at the bond prices and treasury yields, there hasn't been that much of a difference on how much they expect the Fed to make a difference. So I guess the question is, if you're the market and you're expecting some kind of normalization, are you absolutely certain, Alberto, that this will happen? Why do the bond markets don't seem to believe that the Fed is there to start normalizing and continue normalizing?
Well, I think that the real issue is that why are bond markets so relaxed, especially in the long end of the curve? Because they do expect a few hikes, maybe one hike in December, which is totally priced almost, and a couple of hikes next year. But they don't expect an acceleration. They don't expect the terminal rate to go above 2.75. So a very, very gradual normalization. So we haven't seen a tantrum. We have seen a lot of complacency in the long end of the treasury market, and a lot of carry trades that depend on the dollar, like emerging markets, emerging market currencies, continue to be more or less very well followed by investors.
What does it mean for bubbles?
It means bubbles are still floating in the air.
Getting bigger?
Getting bigger. So a lot of assets are overvalued around the market. So our job is to distinguish which assets are overvalued but still investable. There's a few assets which are unloved, like European periphery, European banks, etc. But within the overvalued world, there are a few assets which are dangerous, which are becoming bubbles. So in an environment, well, some of them are, for example, emerging market debt, US high yield, where spreads are at record lows, but companies are doing very exuberant things like buying back stocks, issuing dividends. Cryptocurrencies are another very overvalued assets, although there's a lot of discussion about the technology. Tech stocks, all these things depend on interest rates staying low and staying stable. Now, it could be that we will remain in a very low interest rate environment for a very long time, but there's also a risk that some inflation comes back, or that the corporate tax reform takes place, and that treasuries will rise and these carry trades will be disrupted.